And one well-known market watcher says the NASDAQ 100 right now, which is full of, some of the big names, obviously, that we're talking about, is an ominous company. Those are his words. Let's bring in Jonathan Krinsky. He's the chief market technician at Crest Partners, joins us once again. Jonathan, welcome back.
Thanks, Scott. Good to be here.
Ominous company, how?
Well, what we had coming off the highs a couple days ago, we saw a 3-day decline in the NASDAQ 100 of -8% after hitting a 52-week high. We've only seen that set up 5 other times in the history of the NASDAQ back to 1985. 3 were in early 2000. 1 was in November of 07, and then 1 was recently here in February of 2020. So I think what's notable, obviously those are some ominous dates. I think if we had to draw any type of analogy, it would be the 2000 timeframe. But here's what I think is important and what gets lost. So when people think of March of 2000, there tends to be this big major top connotations. But it really wasn't a top for most stocks. And in fact, and this is what's lost on a lot of people, from March of 2000 through the end of the year, there were 4 sectors that were up 40%. And if you bought the equal weight S&P 500 in March of 2000, you actually made 25% over the next year. Take it a step further, there's actually an index that's a reverse cap weight index where the smallest companies in the S&P are given the most weight. So it's completely the opposite of the S&P cap-weighted index. That actually outperformed the S&P by almost 100% over the next 2 years. So I think our point here, there are some extreme analogies in the NASDAQ 100 that are very analogous to some bubble-like periods, but that doesn't mean that the overall market has to be a concern. And we actually think, there's a lot of talk about this barbell strategy, right, where you're looking at the COVID names and then the reopen plays. But what gets lost is a lot of the names in the middle. So some of the names like the coffee names, Dunkin' Donuts, Starbucks, you guys were talking about those, McDonald's, the home builders. A lot of these are kind of in that middle where they're not the high-flying tech names, they're not the banks or the energy sector. So I think that's where you kind of want to focus right now.
But I mean, you say this is not necessarily a sign that the overall market may be in peril, but you're not suggesting that the NASDAQ couldn't have more room to go to the downside. I mean, you throw out some ominous dates, right? I mean, it's not like 1 or 2 dates. It's like 5 dates, and everybody knows what happened around all of those instances.
Yeah, well, let's be clear. If we're talking about the NASDAQ 100, it's more concentrated now at the top 6 names than it was at the peak in 2000. 6 names represent about half the index. So, the names you talk about, Apple, Microsoft, Tesla, we do think there's some downside risk there. And even after the pullback we've just seen in the NASDAQ 100, we're still 21% above the 200-day moving average. Let's put that in perspective. Outside of the July-August move of this year, that is still one of the most extreme spreads versus the 200-day that we've seen in the last 30 years. So yes, we think there is risk in those big mega cap names, but like we've seen throughout other times in history, there are plenty of other names below the surface that can do well despite those maybe seeing some profit taking. So it's not like it was in 07 where a lot of sectors continue to deteriorate and there was really no place to hide. We do think it's more like that late 90s period where just certain areas of the market got a little bit extended, but there's other areas that can certainly be played for the long side.
Not to minimize it at all, though. I mean, this is a big area of the market that you're suggesting may be overextended. So, Jenny,
go ahead. Well, that is a good point, and given the concentration of those top names, that they are in fact a bigger weight than they were in 2000. If we see further selling there, it's going to be almost impossible for the S&P 500 to make meaningful upside progress. So it could be a situation where the passive plays where you're in these cap-weighted ETFs actually do go down, but the average stock may in fact be flat to higher, and that's exactly what we saw in the last 3 quarters of 2000.